I was adjusting my tie just a few minutes ago, looking out at the beautiful evening light, and this exact thought crossed my mind. It might be the biggest oversight in modern investing because most people have absolutely no idea they are holding the losers, right alongside the winners. Imagine owning one asset that went up 523% last year, while simultaneously holding another asset that collapsed 54% in the exact same time frame. You would probably say that you would never build a portfolio like that, but if you own a standard index fund or a basic retirement account, that is exactly what you are doing. We see the headlines showing the market hitting all-time highs, we feel good, and then we change nothing. I used to think that buying the entire basket was the ultimate shortcut to safety until I actually started tracking the math underneath the surface. Every single week, I look at 150 different industries across the United States stock market to see where the capital is actually flowing. Right now, about 55% of those industries are genuinely strong, showing steady upward momentum with fresh money pouring in. But at the very same time, 64 industries are heading downhill, meaning more individual sectors are falling apart than are climbing, even as the broader index hits records. Let us look at a real example within the exact same index fund during the exact same period. Micron Technology climbed up 523% from its recent lows, while Nike dropped 54%. When you buy a passive index fund, you own them both, so one is pulling your net worth up while the other is dragging it down as hard as it possibly can. The total market cap makes everything look fantastic on paper, especially with 84% of companies beating profit estimates last quarter. It feels like the boom days of 2021 when the financial system was flooded with liquidity, but the reality underneath is completely fragmented. What we are experiencing right now is not a market crash, because if it were a crash, every single asset would be dropping together. Instead, we are witnessing a massive sector rotation, where capital is quietly exiting traditional consumer sectors and flooding into tangible assets. Think of the stock market as a giant swimming pool where the total volume of water stays relatively constant, but one end is getting incredibly deep while the other end is completely draining. The broader index hitting a high simply tells you the pool is full, but it fails to show you which specific corner holds all the water. Energy stocks have climbed roughly 28% this year, making them the top performers, while healthcare and financial sectors are both down about 6%. Technology is up 16%, and raw materials are up 14%. Meaning money is moving with extreme precision. There are three specific macroeconomic forces driving this shift right now, and the first one is the sticky nature of inflation. The consumer price index is hovering around 3.8%, which is nearly double the official 2% target set by the central bank. Energy costs are up 18%, gasoline has jumped 28%, and you are probably feeling that pressure every single time you pay for daily expenses. When inflation stays this high for this long, paper-based assets naturally lose their purchasing power, while hard assets and real commodities win the day. The second force is a metric most retail investors have never heard of, known as the National Association of Active Investment Managers Index. This index tracks how much money professional fund managers are actually putting into equities at any given moment right now. That number is sitting at 97 out of 100, meaning institutional investors are almost completely maxed out. Picture a game of musical chairs where 97 people are already seated, and there are only 3 chairs left in the entire room. When nearly everyone is already fully invested, there is very little fresh capital left to push the entire ocean higher. Therefore, the specific direction of the existing money flows matters significantly more than whether new money is entering the system. The third factor is the stagnation of real wages, which represents what you actually earn after subtracting the rate of inflation. Right now, that real number is negative, meaning the average professional is earning less purchasing power this year than they did last year. People feel frustrated because their paychecks might look larger on paper, but prices are simply rising faster than corporate compensation. This acts as a silent tax on the consumer, which explains why consumer-facing industries like retail and traditional advertising are feeling the pain when commodities enter a structural cycle. Safe havens naturally attract institutional attention. Gold has climbed almost 50% over the past year, driven by a massive shift in global central banking strategy. Central banks are expected to purchase roughly 1,000 tons of gold this year alone, as nations like China, India, and Turkey trade paper currency for physical reserves. Holding pure cash means accepting a guaranteed loss against inflation, and physical gold has served as the ultimate hedge for thousands of years. Large gold miners like Newmont are outperforming the underlying metal, and history shows that when miners lead the physical asset, the trend has real structural legs. Newmont is a massive corporation with a market cap well over $100 billion, making it a highly liquid blue chip asset rather than a speculative bet. The second major area showing stealth capital concentration is uranium, specifically through major producers like Cameco, trading under the ticker CCJ. Uranium prices have risen 21% compared to last year because the entire global economy is quietly moving toward nuclear power. China currently has 60 nuclear reactors running with another 38 under construction, and the United States recently classified uranium as a critical national security asset. The massive data centers required to power artificial intelligence require immense amounts of electricity, and nuclear energy is becoming the only viable scale solution. The United States requires roughly 50 million pounds of uranium every single year, but it only produces about 1 million pounds domestically. That leaves a massive 98% import dependency on a critical resource, driving major interest into the broader sector index under the ETF ticker EURA. The third critical material is copper, which many institutional desks are now calling the new crude oil because the modern infrastructure cannot function without it. Copper prices have surged about 40% over the past year due to a widening structural deficit between supply and demand. An electric vehicle requires roughly 4 times more copper than a traditional internal combustion car, and every solar panel and data center relies heavily on it. Global supplies are actively shrinking due to operational difficulties in major producing regions like Indonesia and Chile, benefiting diversified producers like Freeport-McMoRan. Freeport-McMoRan operates as a massive $80 billion pure-play copper entity, aligning it directly with the physical infrastructure boom. Then we look at the traditional energy sector, which remains the single best-performing sector in the entire S&P 500 this year, climbing over 20%. While retail investors spend all their time debating whether technology stocks are overvalued, traditional energy infrastructure has quietly beaten almost everything else. A business like Total Energies, which holds a market cap around $160 billion, is printing massive cash flows because it owns diversified oil, gas, and renewable assets. When commodities experience a structural supercycle, it triggers a massive secondary boom in heavy industrial infrastructure and domestic defense. Residential building contractors have seen their industry metrics climb by over 300%, while engineering and construction firms are up 200%. These are not speculative meme stocks or volatile digital currencies. They are concrete businesses building physical data centers, power systems, and pipelines. Every major tech giant is currently spending billions of dollars on physical infrastructure, which requires advanced cooling systems, massive power grids, and specialized chips. A company like Broadcom supplies custom artificial intelligence architecture to the largest cloud providers on Earth, pulling massive institutional capital. At the same time, lesser-known engineering firms like Comfort Systems, which handles complex mechanical and electrical installations, have climbed over 500% from their lows. We see similar dynamics in structural data storage providers like Seagate and advanced electronic manufacturing services like Celestica. The passive investor holding a standard index fund misses the concentration of these specific moves because the broader index dilutes the stellar performers with fading legacy names. The defense sector reflects a similar reality as global expenditures scale up, with entities like Rocket Lab expanding their technology footprint into space launch systems. More conservative defense blue chips like RTX, formerly known as Raytheon, are seeing massive order backlogs build up as nations upgrade their hardware. The macro trend of bringing manufacturing back to domestic soil is a multi-decade shift supported by massive government infrastructure funding. This directly benefits industrial construction businesses like Mastech, which specializes in building high-voltage power lines and energy pipelines. Now, let us look at the other side of the ledger, which is the part that should make passive index investors incredibly uncomfortable. Remember that nearly half of the industries in the market are actively losing capital right now, and these are not obscure startups. These are household brands that occupy significant weight inside your standard mutual funds and passive retirement portfolios. Shoe manufacturing is down significantly. Professional consulting firms are losing ground, and corporate advertising budgets are actively shrinking. As artificial intelligence tools become more integrated, legacy consulting and information management services are seeing their traditional business models disrupted. Major advertising conglomerates like WPP have seen a massive portion of their market value slide over the past few years, yet passive index funds keep buying them. Let us look at this in terms of actual numbers. Because percentages can often feel completely detached from everyday life, if you had placed $10,000 into a standard index fund 2 years ago, you might be sitting on roughly $13,000 today, which looks like a decent 30% return. But if that exact same $10,000 had been allocated exclusively into the specific rising industries, that capital would have grown significantly larger. Conversely, if that money had been tied to the declining industries, your $10,000 would have shrunk down to a fraction of its original value. Your broker gives you a statement saying the overall market is up 9%, but that average hides a volatile mix of rocket ships and sinking vessels. The difference between capital preservation and capital destruction is not a matter of luck or trying to time the exact bottom of the market. It is simply a matter of watching the data and acknowledging where institutional capital is actually being deployed in real time. The classic textbook advice of buying and holding the entire market forever worked beautifully for our parents and grandparents during a completely different economic era. Today, that strategy forces you to remain anchored to dying industries under the traditional label of diversification. Wall Street firms do not simply buy the whole market and sit completely still for 3 decades. They constantly rotate capital as macroeconomic realities shift. They promote the passive narrative to retail investors because it creates a stable pool of predictable liquidity, allowing large institutions to trade around the public. They collect consistent fee revenue from passive products while keeping everyday capital stationary, while the smart money shifts to capture the real structural spreads. In an era where technological disruption is accelerating at an exponential rate, holding a legacy company forever carries immense structural risk. The speed of innovation makes it incredibly easy for new platforms to completely hollow out established businesses in a matter of years. When the gap between the structural winners and the structural losers becomes this wide, the blended average of an index fund inevitably holds you back. Understanding the actual rules of the financial game is the only way to avoid spending years watching your capital move sideways, while real inflation chips away at your purchasing power. Building sustainable wealth does not require chasing volatile trends. It requires looking past the comforting headlines and trusting the cold certainty of mathematics.